But now, the next idea I want to take you through is tax jurisdiction. But tax jurisdiction for individuals and for companies. And this sort of dovetails into tax credits and specifically USA approach to what is a legitimate foreign corporation subsidiary, okay? Direct tax, indirect tax. So we're going to have a look at that. All right? So that's what we're going to cover now. Tax jurisdiction, moving into tax credits, but when it gets to tax credits, it really depends on whether we're looking at direct taxes or indirect taxes, okay? And the direct taxes are associated with branch operations, indirect taxes associated with subsidiary operations. All right, so let's get into the good stuff, shall we? Are you all ready? All right, so you've got to be very, very alert here because I'm going to give a whole framework that's not in the textbook, that's not in the video, but it's in the classroom. We're going to give you a reason to come to the classroom. It's not just for taking attendance. Okay, we've got taxation approaches. There is the worldwide approach, tax on income of resident, company of a country, regardless of place of earning. Then there's a territorial approach, and then worldwide, territorial, yes. So which is which? That's the big question I have for you. So which approach does US take? Definitely worldwide. They like to say it's worldwide, all right? But it's basically, if you're a US citizen, then we just tax you on your worldwide income. Okay? So let's put that down as that worldwide, and maybe we do a big funnel like this. So very broad is worldwide, right? Okay, worldwide. Okay? And then that's worldwide based on citizenship. Okay, that's USA. All right, USA. Okay, but we can do worldwide based on residency. Okay, and that's when we talk about residency is we're going to tax you, you're a resident of our country, you've been in a country for more than 6 months, then we tax you as what you have earned in that country plus what you have earned overseas. Okay, so Australia has this residency approach. Okay, Australia. Okay, China has a similar approach. Okay, you need to know that. Okay, because if you're, in some ways, you are a China tax resident still, and you'll probably go back and work in China, you're a China tax resident, then your tax, say if you left, you know, you took a suitcase of cash to your bank account in Hong Kong, and then you put it into some investment and it starts earning you dividends. Well, in Hong Kong, you don't have to pay tax on the dividends. All right? But you go back to China, you become a China tax resident, you receive those dividends, you've got to pay tax on those dividends. Did you know that? Put your hand up if you knew that. Now you do. Ah, wow. Really? Yeah, of course. Okay, that's what residency is about. All right, except in Hong Kong, which is Hong Kong with very, very, we're talking about territorial. Hong Kong is very, very friendly. Hong Kong. Why? Because Hong Kong taxes you on what you earn in Hong Kong. And what you earn out of Hong Kong is, even though you might get dividends from overseas that comes into your bank account in Hong Kong, then you don't have to pay tax in Hong Kong on that. Wow. Isn't that cool? How many of you want to live in Hong Kong as a tax resident? It's a good idea, isn't it? Hey, you're here to get some, I know why you're here tonight. You're here to get some ideas, aren't you? Yes. It's not just about the exam. This is real stuff we're talking about here. All right? Big difference between China and Hong Kong. One country, but two systems. Two tax systems, definitely. Okay? And this is the way it is. All right? Not only that Hong Kong has a lower tax rate, but it has a very narrow, see? Wide, narrow, wide, narrow. You got that idea? All right? US, very wide. Territorial, very narrow. You see that? All right? Citizenship, worldwide. You're a citizen. I don't care where you are. You're still a US citizen. I tax you on your worldwide income. You have to go to Mars if you want to avoid tax. Okay? So that's basically what we mean by the worldwide territorial approach. Worldwide, very wide. Territorial, very narrow. But two types of worldwide. Citizenship. So it's not like you change citizenship every year. But when you get a job in another country, your residency changes. See? So that's why residency is narrower. Okay? So I'm an Australian citizen, but I make sure I don't go back and spend half my time in a year in Australia to become an official resident of Australia. Because if I become an official tax resident of Australia, then I am liable to declare all my worldwide income as a tax resident in Australia. Okay? All right, so that's what we mean by tax jurisdiction. Now let's move on. I want to go to the next part, and that's as it applies to the individual. But now we want to apply it to the company. So let's have a look at, there's some more examples of the tax jurisdiction, like in Austria, followed by most countries, base is source. USA citizenship, this is very broad. And residence, Australia, Germany. So, and Hong Kong focuses on source, so very narrow. In other words, you're only taxed on your income that's sourced in Hong Kong. Okay? All right, so there's another way that they describe it in the PowerPoint. But I like the funnel, I think, is really good. Territorial, or you could say that this is kind of like a source. All right? All right? And citizenship and residency. Residency is broader than citizenship. Wow, you cannot hide. Okay? Because very few people change their citizenship. That's why I argued last week, FATCA, F-A-T, FATCA, or Foreign Accounts Corporation Taxation Act, all right, is much stricter than the Common Reporting Standard here. Because this is based on residency, which can change from year to year, right? Right? But here, citizenship, you know, a bit hard to change, isn't it? Bit hard to say, oh, I'm not a US citizen when you are. Okay? All right, so big difference between the two. So I was really happy last week when they said, oh, it's about residency. Whew. It's okay. Bit of flexibility, bit of wriggle room.